6/12/2012. How about that? 11:25 a.m. Happy Father's Day week to all the fathers out there. But most importantly, right now we're looking at the SMLX, called the CBOE S&P Small Cap 600. This is a weekly chart, and it had a great run in 2012, and it's a good gauge of the economy. They work well when they're stimuluses, and they have great trading cycles at times. And one of the things about the calendar year is that you have that bull cycle, and the small cap lead the way down here when we were making the lows in 2011 here. But this is that December period right here. And we were making lows. That was our first low. We traded them up, and we traded this one here. Small cap is good at times, but they put in their all-time highs, as we said. The problem with small cap in the near term, starting July of 2012, is they're going to have a reporting session again. And small cap earnings are going to have to be marked down with estimates. The CEO barometer indicator is as follows, is that, hey, yes, you got gasoline coming down. Yes, hey, you finally got such good low rates that some people that do have some money left in the economy, they can go out and get houses at lower rates, try to get that refinancing. The problem is that when the stimuluses wear off, small cap does a little bit weaker, but it's always a gauge of the blockbuster part of the economy because you want to see them doing well. Now, here are the small cap companies. They're all right in here. Some are better than others, and they're diversified in different different parts of the economy in the small cap area. It's always good to know one thing about small cap is where are they? They are very weak. The 10-week has crossed over the 20. They've had 4 weeks closing below the blue line, the 10-week moving average. That means that the current trend in itself is in a bear, not a bull. You're about to go into a weekly sell signal. The earnings estimates in these names and equities will need to be marked to market down in the earnings cycle. We're not saying that they're going to collapse, but we're saying that there's weakness, and this was forecasted 6 months ago. Once we would put in this bull rally that we're doing and how it's working, and why it was time to be short up here, and why the S&P mid cap I showed earlier has a relevance to this small cap. I'll tell you why. Because usually the small cap will lead the rallies before rallies start. Okay? As far as bull rallies go, you put in the bottom over here in the small cap, you get that great 4-week up move we got, you come back, you test it, you burn it up, you consolidate it right here in the last period of 2011, December, and bam, small cap had led the way, but it started over here. And then it continued. But it's also one of the ones that made their diminishing topping patterns and reversed right away as well. And that the current 2012 trend for the retail people out here, MMTs, for you, all you have to know is that they're trying to put a bottom in, but the small cap is reaching resistance. It does take small cap to lead rallies. Period. So between 6/12 of 2012, when we start getting in the middle of July after the holiday, July 4th, we're going to get into that quarterly earnings. And what I am telling you, as I have told you from the last quarter and last year, that stimuluses work well, and Mr. Bernanke will have to do QE3 for the small cap. Don't fight the Fed. However, these growth cycles, the growth cycles could go much lower in the small cap. It just depends on how that pass through products and services to the small cap industry in the U.S., for that matter, is going to lose money. And how do they lose money? Well, they're not hiring, they're not making as much, their margins are more narrower, they have to come down. There's a lot of uncertainty out here for the small cap industry, and the thing about it is they're always going to be the gauge if you're going to go back into a bear market trend, or if you're going to even go back into a bear economy, MMTs. And it's always important to really monitor how this bottom is being put in on a weekly level, which is good. It's at jeopardy of breaking down and going back down into the 2011 lows over here, for crying out loud, if it breaks these support levels. Now, the risk is that it takes all areas of the market to lead bigger rallies higher. The problem is when there are certain ones that are left out of the equation, you don't get as big as bull run in these kinds of bear trends, because number one, seasonality, and number two, slower growth means that why do people want to bid these back up to the high? They're not. Not in the very short term, they're not. And they too will have a growth contraction, and US GDP could go a whole lot lower if things don't work out right here, abroad, and over in Europe and around the world. Yeah, you could go into a terribly slowdown period in a small cap. We'll find out what happens at year end. If the US government is going to stimulate them, at least our small cap US companies, they're more sound than a lot of other companies around the world. So there is some truth to safe haven to them. And the thing about it is you're going to have Mr. Bernanke step in and do QE3. So I'm telling all of the client base and all of our friends around the world that these stimuluses are going to have to be much more powerful to have any long-lasting effect. And that the small cap, the mid cap, remain at extreme high risk as far as using it as a gauge, potentially, that if the U.S. gets wounded from slower growth around the world and the global picture continues to do exactly as forecasted, and stimuluses will have to come in play. They have no choice. So, once again, watch all of these sectors. S&P 100 is different. That's the large cap. There's some high dividend yielders in there that people purchase. The S&P 500, there are some good ones in there, and people are going to be buying energy, natural gas, things like that we can find that would do you good to have some call options on some of these plays that are beaten down right now in the mid-year that have already got earnings priced into a bad quarter. But where is that next bigger trade's going to be? Technology and semiconductors are always weak in every sector and every class, whether small cap semi or bigger cap semi or medium cap. It doesn't matter. Seasonality wise, that and tech don't do well in the summer. They don't. And with slowdown here, then earnings have to be marked down. So, once again, to our friends around the world, it's important for you to know that even when you're investing in the U.S., yes, the U.S. is a safer place to be. However, the U.S. will experience a slower growth pattern over the next 2 quarters, and potentially worse after that. The bull cycle to it all will be dependent on QE3 injection into the system by the Fed.